Hello, everybody, and thank you for being here today. Howard and I will talk today, as Tanya mentioned, about acquisition financing and some of the elements that we need to think of when we're proceeding with an acquisition and how to finance it within the confines of credit facilities that are often already in place or are to be put in place with respect to the acquisition. For today's topic, we'll try to take a balanced approach in our conversation, which is to look at both from a lender's perspective, where some of the issues that they highlight and they care about most, and also from a borrower's or acquirer's perspective, where they seek flexibility in their credit instruments that will facilitate their acquisition strategies. And what we thought of doing today to best show that to you is to take a scenario of what are the different elements when thinking about doing an acquisition, the different instruments that a company will be party to, and how to make sure that they align with each other so that there's no conflicts and the acquisition can proceed. And so to do that, what we're looking at is principally a company will have a credit agreement that's in place already, and the credit agreement will have restrictions in it that the borrower needs to abide by. So what we try to find in application is what we would call a permitted acquisition. So in what circumstances can a borrower make an acquisition and it's permitted to do so within the confines of its credit instruments? Within that, when we talk about an acquisition specifically, we want to make sure that the conditionality of utilizing the financing are reduced as much as possible so that the borrower is not handcuffed with, on the one hand, an acquisition agreement where it must pursue an acquisition, and on the other hand, a credit instrument which restricts or doesn't give them the financing that is required. So we'll go through the different limited conditionality credit facilities that exist, and we'll give a little bit of an overview onto what the US tendencies have developed over the years and what the UK or European models have developed as well. Finally, we'll take a look at within the acquisition agreement itself, so the purchase agreement, whether it's a purchase of assets or a purchase of shares, what type of provisions would be baked in those agreements, which would impact the facilities that are available under the credit agreement. So how the two intertwine with each other and need to be aligned, and things that we need to think about those things. And then we'll try to summarize that with some key takeaways. So that's the agenda for today. I don't know if anything.
If we have some time at the end, maybe we'll revisit a transaction or a very significant acquisition that one of our clients did that really tied into a bunch of the things we'll be talking about today. So we'll see if we get the sign early, or if not, we'll save that for another session.
So the first piece of the conversation is what constitutes a permitted acquisition.
And Serge, if I can, maybe before we start, because one thing some people might not appreciate is in pretty much any credit agreement, from an investment grade company to a startup, there's going to be a negative covenant which restricts investments that can be made. And the definition of investment is fairly large. In an investment grade company, it's typically a very light covenant, but for even mid-size companies, the lenders tend to want to have some restrictions so they can limit what they envision as risk, and don't want to agree in advance to give too much latitude to a borrower, because if an acquisition or other type of investment changes the credit profile, they may not necessarily have been compensated for that or bargained for it, and as such, what we're going to talk about right out of the gate is one of the items that is an exception to this restriction and allows borrowers to proceed with acquisitions without going back and getting lender consent, which, depending on the circumstances of the company and the lender or lending syndicate, may well be challenging, despite the fact that it could be, in the borrower's mind, something that is in their best interest to proceed with.
And so with that mindset, as Howard explained, you have a negative covenant in invariably all credit agreements, which state that the borrower is not permitted to perform an investment. An investment will include the concept of an acquisition. And so what needs to be done out of the gate when we negotiate credit agreements, from the borrower's perspective, is to ensure that there's an exception already in there which allows the borrower to perform a permitted acquisition as we defined it. And on the lender, from the lender's perspective, that definition is balanced in the sense that the lender is protected and understands what is getting into. And some of the things that we need to think about in here is, in what circumstances should the permitted acquisition apply? And importantly, from the lender's perspective and the borrower's perspective, what loans will be available to fund that permitted acquisition? So you'll have a use of proceeds provision in the credit agreement, which states in what circumstances you can use the proceeds. You therefore need to make sure that that use of proceeds allows you to use those funds for an acquisition, and particularly permitted acquisition. Now, whether that is a delayed draw term loan, for example, whether that is the existing revolving facility that is under the credit agreement for which you're allowed to use it, those are negotiating points, but it's important that if your use of proceeds is so strict that doesn't allow you to use it for your acquisition, then right out of the gate you wouldn't be able to use it. So when we look at credit agreements themselves, we see the concept of permitted acquisitions which are included. And this will have a bit of a ripple effect through the agreement to see where that's used. So a few examples of that is acquired indebtedness. You'll have a restriction on indebtedness that you're permitted to incur or to hold on your books. Well, if you do an acquisition, chances are the acquired entity already has indebtedness, and therefore that indebtedness that is acquired needs to be permitted. There'll be baskets around that. The lender may request that it's only purchase money types of security interest or capital leases. For example, there's a cap on that it has to be unsecured. So there may be variable ways of protecting that, but from a purchaser's perspective, if you're not permitted to acquire an entity that has debt, then again, you'd have to seek consent after the fact from the lender. Earnouts are a common practice in acquisitions. So many times acquisitions will be structured in a way where part of the purchase price is paid over time post-acquisition. That would qualify as debt under the credit agreement and would therefore need to be permitted up front. Adjustments to financial covenants. So many times financial covenants are structured in a way where they calculate the EBITDA, the earnings, or other measures of the borrower. When an acquisition is made, those earnings are subsumed within the borrower. An important question which would need to be negotiated is, how do you in fact adjust the financial covenant calculation or the earnings of the company based on the acquisition? Because there's history that comes with it. And so do you measure that calculation from the moment of the acquisition, or are you permitted to use the benefits and the disadvantages that come along with it within your financial covenants? And oftentimes you do want to include those benefits on a historical basis so that your leverage covenant ratios, your other financial covenant ratios get a real sense of what the new business post-acquisition looks like.
Not to mention that if you are doing the acquisition with leverage, if you were just adding leverage and not getting the benefit of the EBITDA of the target which was acquired, then you're likely to put yourself in a very difficult position vis-a-vis your financial ratios. And that's why for most acquisitions, they get pro forma treatment where the EBITDA of the target is deemed to have, for purposes of calculating EBITDA, the target is deemed to have been acquired on the first day of that period that's being tested. So that's a complete fiction, because if you close, for instance, on December 1st and you're going to measure your covenants at December 31st, you are going to be deeming the target to have been acquired on January 1st, when obviously that didn't happen. But like I said, otherwise you end up in a situation where you could easily trip your covenants if this weren't contemplated in the credit agreement.
Right. Said differently in the example, as of December 1st, you've incurred all of this new debt. So that will obviously increase your leverage. But the earnings are only as of December 1st, right? And don't calculate the whole year portion of the earning from the target that has now been acquired. So it's an important adjustment that needs to be made in the financial covenants and in negotiation between borrowers and lenders. Another thing that we see oftentimes in credit agreements are under mandatory prepayment provisions, where any equity issuances or equity contributions that are made or excess cash flow that arises have to be applied to mandatory prepayments under the credit agreement. Most acquisitions won't be funded solely by debt, but will be funded through equity as well. So it's important that there's exceptions in those rules that allow the borrower to be funded in equity if the purpose is to fund an acquisition without having to repay the debt. Otherwise, you'll have a conflict in that calculation. So what does a customary definition of a permitted acquisition look like? What do you typically see in a credit agreement, and what kind of conditions need to be satisfied in order for the borrower to fit within the already accepted basket that the lender has authorized? So, I mean, obviously it will depend on the profile of the debtor. As Howard mentioned, an investment grade company will have much less conditions, very few, possibly only one, which is no default. In a mid-market type transaction, tighter credit, the list could be very lengthy. So let's go here through a couple of examples just to give you a flavor of the types of things that you should think about if you ever were in that situation. No default or event of default is an obvious one. So clearly, the lender would not want you to proceed with an acquisition if at the time of the acquisition you're in default. That the acquisition is for all or substantially all of the assets. So or substantially all the assets of a division. But just a small acquisition or portions or pieces of collateral wouldn't fit within that exception. Typically, the acquisition needs to be consensual. So a hostile takeover is not something that lenders are very favorable to and won't agree to it up front. Of course, anything is negotiable and can be discussed, but as a permitted exception, they usually won't accept that. Indebtedness. So the acquired business, if it has indebtedness, there'll be, as I mentioned earlier, there'll be certain categories of indebtedness that they'll permit that to survive, but not all indebtedness without exception. Compliance with financial covenants as adjusted, which we had discussed before, so on a pro forma basis. Due diligence package. So the lender will obviously want to see the due diligence that the borrower has conducted on the target. The question now becomes, what is the level of diligence that needs to be provided and when? Typically, lenders will want to have advance notice, could be 15, could be 30 days before the acquisition is consummated, with final documents delivered a few days before. Obviously, the longer the period, the more difficult it is for the borrower, because the borrower will want to have advanced its diligence as far as it can before the acquisition is disclosed to the lender.
I would just add to that, Serge, that in some permitted acquisition definitions, effectively, the diligence package that the borrower receives, it has to pass along to the lenders. But in some situations, these definitions will provide that above a certain purchase price, there are certain required elements, regardless of whether the purchaser or borrower wanted to obtain them. So, for instance, it could be provided that if the acquisition is above $10 million, that there needs to be a quality of earnings report. Now, the borrower purchaser may have thought, we don't need a quality of earnings report for whatever reason. But in order to fit within permitted acquisition, that would be one of the elements. Like anything else in a credit agreement, if you have valid reasons for not obtaining one, and you want to go to your lender and ask for a waiver, if the justification is right, it's hard to imagine that they will not agree to it. But the whole idea behind this definition is to give borrowers comfort that they can do things without having to go back to the lenders in advance.
And you're right. The idea is that you want to have already your permissive language in the credit agreement. If you have a single lender, the negotiations are probably easier. But if you have a syndicate of lenders, one of the last things you want to do is to have to go back to a majority of lenders or a supermajority and ask for a consent that you feel is not necessary for you to pursue a strategic or transformational acquisition. Additional criteria that we will often see are same line of business. So obviously, if we're doing some sort of acquisition in a continuing business, that makes sense. Lenders would not want you to sway too far away from that. The jurisdiction of the acquisition. If you have a North American deal, Canada, US, known, we know how to handle that. In Europe, a lot of times you'll see permissions in the UK or some other European jurisdictions, but there may be many jurisdictions which are excluded from the permissive language because it could change the profile of the borrower. Accretive EBITDA. So in many cases, transactions in which the EBITDA of the target is either negative or would have a negative impact on the borrower on a consolidated basis may require additional consent before they're pursued. If they're accretive or they're positive, that's a given. And then, of course, once the acquisition has occurred, there will usually be a slew of provisions which provide that within a certain period of time, 30 days, 60 days, the target will have to accede to the credit agreement as a guarantor and provide security on its assets. Now, that's an important factor because when you're looking at potentially doing an acquisition, you therefore need to make sure that the target, once it is acquired, is capable of becoming a guarantor and giving that security. Otherwise, you may be permitted to do the acquisition, but you won't be able to fulfill your obligation afterwards. And finally, what we often see also in these agreements is caps on permitted acquisition. So there may be an overall cap and there may be an individual cap. Each acquisition cannot be more than X, and in the aggregate for the life of this transaction, you cannot do more than X number of transactions for a total basket of Y. So that gives you a glimpse a little bit of in what circumstances a borrower can pursue an acquisition without having to go back to its lenders and ask for permission, because these are already permitted, and as long as they fit within the confines of those. The next question which comes up is, how do you fund it? How do you fund this acquisition? You're permitted to proceed with it. You need financing for it. If you need to go to lenders individually and solicit commitments from all lenders upfront, it's a challenge. It's a task that needs to be taken. But more importantly, once the lenders have said, yes, I'm willing to fund this acquisition, I will put these commitments in place. What are the conditions that need to be met in order for the financing to actually fund? And there may be a significant delay between the time of the acquisition is announced and the time that you closed. In any two-step transaction, you'll have signed a purchase agreement, so it fits within your permitted acquisition exception, but you may be faced with regulatory approvals, shareholder approvals, third-party consents, and these can take months, up to a year sometimes, to obtain. If the lender has committed for the financing upfront, what you don't want to happen is that 6 months later, when your approvals come in, the lender pulls that commitment away. And so we need to limit, to the extent possible, the conditions that go along with those transactions.
And, beyond from the borrower's perspective, we are in and have been for a while in what many would say very much a seller's market. Attractive targets of all different sizes have multiple bidders. So it's not just the borrower has a vested interest in knowing that there will be financing, it's also the sellers. Historically, there used to be many purchase agreements that were signed with what were known as financing outs, so that if the buyer was unable to come out with the financing, they would have no legal obligation to proceed, albeit there may be a fee to be paid. I think many people would tell you who are active in the M&A domain that although price is the number one concern of any seller, right after that is certainty of closing. And a big aspect, especially in acquisitions that are done by private equity firms, which tend to be significantly leveraged, is how certain are they that closing will occur? How closing of the financing will occur. So there are really two ways to look at it. There's an acquisition that's done in the context of a brand new facility, which is being put in place for the targeted acquisition and that will, continue for the consolidated group after the closing, and then one which is within an existing credit agreement. Now, if it's within an existing credit agreement, Serge alluded to it earlier, there's something called delayed draw term loans. These are loans for which commitments are already in place for the lenders, and they have said if you satisfy the criteria, meet the use of proceeds requirement, that they are obligated to fund. There's also within credit facilities reference, you may have heard different terms, incremental loans, accordions, additional facilities. These are uncommitted facilities. So there's no lender that's said, I will lend under these facilities. But by the same token, the existing lender or lenders are telling you in advance, well, if you can find lenders who want to provide commitments for this facility, we will not be able to block you on the basis that you have too much debt, subject always to respecting your financial covenants. So an accordion or incremental loan is if you can fit it in and you can find dance partners, as I would call them, then you can finance it. What I'm going to talk about, sorry.
Maybe I'll add a point there because I think it's an important nuance to make, because we often get the question of, well, if the incremental loan or the accordion is uncommitted, what's the value? You have to go see the lender in any event. The answer to that, and I think the real value, is that if you already have negotiated within your credit agreement a structure which allows you to raise additional debt, and a structure that says that the funding of that debt will be on limited conditions, which we'll take a look at, and will form part of the term loan. So if you already have term loans in place, this comes as a new tranche, ranking pari passu with all the other lenders. Then the reality of what most borrowers will do is they'll approach one lender. So they'll go see one lender and they'll say, I want to do this acquisition. This is the value of the acquisition. Would you commit to fund this acquisition based on the structure that's permitted in the credit agreement? Now, after announcement, you may go and syndicate that to the other lenders. But the borrower only has to negotiate with one lender as opposed to 6, 10, 20, however the largest syndicate is, upfront, can pursue its acquisition, can close the purchase agreement, and then in the interim period can rejig if the need be with the other lenders. But it allows that flexibility that we don't have to reopen up the entire credit agreement each time you want to do an acquisition to solicit the consent of all the lenders.
Yeah. What we're going to talk about for the next couple of minutes, though, is in the context of really a new credit facility or credit facilities that are being put in place because a borrower plans on doing an acquisition. And the first step of that is a commitment letter. A commitment letter is not a full-blown credit agreement, but rather a binding agreement on the part of one or more lenders to commit to advance funds if the conditions set out in this commitment letter are satisfied. And within the commitment letter, there is also, I would say, understanding agreements to reflect the terms in a definitive agreement that will be prepared, prior to the closing of the acquisition. But it's not as much it's a condition precedent, it's part of the agreed upon package. So we're talking about a commitment letter. Internal credit committee approvals have been obtained by the bank, and they have said, if you are able to satisfy these conditions, we will fund. Did we do something wrong? No. Okay. Okay, great. So when we're talking about limited conditionality, many people have heard about SunGard provisions. SunGard is really short for SunGard Data Systems, and in 2005, SunGard was acquired by a consortium of private equity firms. And SunGard really brought the United States first and subsequently Canada closer to where things had been in Europe for many years. And that really is limited conditions to the funding of the facility that will enable the acquisition to be consummated. So it replaces the traditional long list of conditions precedent that typically exist for advancing new credit facilities, and most importantly, significantly limits the conditions that are applicable to the target entity and relies on conditions that are within the control of or the knowledge of the borrower/purchaser. So what are some of these conditions? Closing of the acquisition, issuance of a borrowing request. I would say also, other customary ancillary documents such as officer certificates, corporate resolutions, and legal opinions. No payment or insolvency event of default. And then a bring down of specified representations, which would initially be made when the commitment letter is signed, but then subsequently at the closing of the financing. And with respect to the target, none of those representations would cover the target entity, but rather, and we see this in many commitment letters, if the target or the target group had suffered a material adverse change, that would be a condition that situation would enable the lenders to not fund. So the initial reaction is, well, that deviates from what you're saying. But the way that these MAC clauses, I will call them, are structured in the commitment letter is that it either refers to or the language is identical to what's in the purchase agreement. So effectively, if a purchase agreement contemplates that a buyer does not have to proceed with a transaction if there's been a material adverse change, that is mirrored into the commitment letter and ultimately the credit agreement, so that although the lenders can say, we're not going to fund because there's been a material adverse change of the target group, the purchaser is in a position to turn around to the seller and say, sorry, we have no obligation to close and we are not going to close because there's been a material adverse change in the seller group. The other thing that used to exist that's fairly infrequent now is a material adverse change relating to disruptions or changes in the financial, banking, or capital markets. Until, I'd say, 5-7 years ago, you still saw that. Maybe it's a remnant of the financial crisis, but that's just not something that in particular private equity sponsors have been willing to live with, and lenders have been willing to forego that, so that that is not something that they could hold their hats on in order to not fund. So we talked about this, or I referenced the specified representations earlier, and really these are specified representations of the, let's call it the purchaser and its existing subsidiaries. Again, as I said, things that they control or should know will be true at the time of closing. The legal existence of I'll call them the existing loan parties. The power and capacity to perform their obligations. The due authorization of the loan documents. No conflict to the organizational documents, articles, bylaws, partnership agreements that are the existing obligors are subject to. Binding effect, enforceability of the loan documents, the solvency of the consolidated group. There is also requirements or representations that are tied to anti-money laundering, anti-corruption, and anti-terrorism. As you may know, these have become very significant points with the legislatures in the different jurisdictions, and in particular the United States. So for reputational and legal reasons, this is something that they will not forego. And this sometimes extends to some of the target entities, and that'll tie into something we talk about later that's typically woven into the purchase agreement to make sure this could be satisfied. And then there's also the validity of security. Sometimes security against the target group is taken post-closing, and sometimes it's taken at closing, but it can only be security where the filing at the Register of Personal and Movable Real Rights or under the Personal Property Security Act in the various common law provinces is the only thing that's required in order to perfect or render opposable the security. Sometimes, and not in all SunGard transactions, there can be some representations limited that are tied to the target. But a little bit like the MAC clause that I referred to before, these have to be, in addition to the types of representations which, if they're not correct, the purchaser would not be obligated to consummate the transaction, but also have to be material to the interests of the lenders. Again, the whole goal here is to ensure that there's a small number of items which could preclude the funding of the acquisition from occurring, assuming that the purchaser gets to the point where they have an obligation under the purchase agreement to close.
And we get questions on the specified representations because there's obviously a list that needs to be achieved. But as Howard mentioned, these are really fundamental reps on the purchaser that it exists, that is capable of entering into contracts. As you know, credit agreements have a long list of other reps. There's no litigation against me. There's no judgment against me. My material contracts are in place. All of that set of representations and warranties, while they remain in effect under the credit agreement, do not need to be satisfied in order to trigger the lender's obligation to fund the acquisition. And that really is the key here, is that the conditions are in fact have been reduced for purposes of funding the acquisition.
Another key item is on what date are financial covenants going to be tested. Because again, a purchaser doesn't want, nor a seller want to have risk that they only get tested down the road. Like Serge said, in some transactions, the timing between signing and closing could be several months, whether because of regulatory requirements, reorganizations that are required, or particular circumstances in connection with an acquisition. So in many instances, financial covenant compliance is something that is either tested at the date that the commitment letter and the share purchase agreement are signed, or possibly, if it's not tested, at least the EBITDA that's going to be used for testing the, or being used for the leverage test or other financial covenants is established, whether based on equality earnings or otherwise. So therefore, the only variable ties into the leverage piece. And if for some reason that became an issue, that can always be solved by contributing more equity. I think the only thing that is, or the only clear exceptions is would be an insolvency event to default and the failure to make any payments. Again, the non-payment is a bit of, I don't want to say a moot point, but in many instances, any amounts that have to be paid are either payable on the day of signing or on the day of closing. They end up being amounts that are deducted from the initial drawdown.
So that's an overview of the U.S. approach. And while originally, as Howard mentioned, a U.S. approach, it has become quite prevalent in the Canadian market as well. We see them routinely now in whether it's a cross-border Canadian transaction or a purely Canadian transaction, where sponsors, private equity firms are interested in building in these types of protections from their perspective to ensure that funds will be available when the acquisition closes. And this has been going, as Howard mentioned, SunGard was 2005? 2005, so the first few years, 5-6 years, U.S. market only, started to trickle in. And I would say now, when we are here in Canadian market, it's almost invariably seen in acquisition transactions as well. So if we turn our attention now to a bit of a different construct, what about the European model? Because we are starting to see that as well, given the fact that many transactions now are being exported from Canada abroad. And Canadian organizations are looking for acquisition targets, not only in the US, where SunGard is prevalent, but also in Europe and in the UK. And sometimes looking at public company takeovers in the UK, which are themselves subject to very strict rules, particularly when a bid is launched and a transaction and the market expects a transaction to close, that funds are effectively certain from the announcement until the closing occurs.
Yeah, and before Serge gets into it, the Canadian standard under Canadian securities laws is that if you make a bid, you have to have adequate arrangements in place in order to ensure that the bidder has the required funds available for it to complete the acquisition. But that is a very general statement, and as we'll see in a moment, in the UK in particular, and I'm not sure if it arose because of some bids that went awry, it is very strict and very different than what you see when takeover bids are made in Canada, and I'm told there's a similar requirement in the US that's not really any significantly more onerous than that in Canada.
So the UK approach, and we've had the opportunity here to participate in a number of transactions where this has arisen for some of our clientele. And with the UK approach, and a public company takeover is governed by regulation. So there's what's called the City Code on Takeovers and Mergers, and Rule 2.7 more specifically, which addresses the requirements in that setting. Very strict rules that need to be followed. So, as a disclaimer, we're not UK lawyers, but we participate in these transactions to see the impact of our clients who wish to put a bid in the UK and the challenges they face because perhaps the credit agreements here don't allow it, or just the market knowledge of those things are not aware of. So what are some of these requirements? Well, effectively what happens is that at the moment where a public announcement is made of a bid, the transaction as we understand it has effectively closed. And what we mean by that is every document, every stitch of paper has been negotiated, is signed, sealed, and delivered at announcement, which is dramatically different than what we have in the Canadian or the US market. As we alluded to earlier, in the Canadian-US market, you may have just a commitment letter by lenders which say, I will fund on these conditions. Here you need the credit agreement, the fully baked credit agreement. You need the security documents. You need corporate documents. You need legal opinions. Everything needs to be delivered at the time of announcement. And these rules need to be confirmed. There's what's called a panel, which is a regulatory authority which oversees all of these transactions, and if you aren't going to fit specifically within a requirement, you must seek an exemption from the panel. The content of the announcement, the revocability of the announcement, all of it has to be scrutinized and is disclosed publicly. One of the interesting rules on that is what they call the Rule of Six, and the Rule of Six is effectively limiting the number of parties which may have knowledge of the transaction before it is announced. And this could be difficult to manage sometimes. If you have a large syndicate of lenders, you cannot involve your syndicate. You can only deal with and count them, right? You have the sponsor, you have the purchaser, you have their banks. If you have one or two banks, you're already at four, right? So it's very difficult to fit within that six. Oftentimes you want to engage a financial advisor, which will advise on the transaction, a tax consultant. So it's a limiting concept. A very important part of the transaction is the financial advisor with respect to the transaction. So not a financial advisor that is engaged for the borrower or for the target, but an independent financial advisor, which is typically a bank or a banking institution, which needs to make a cash confirmation. And what that means is, so for example, if a large financial institution in Europe is selected as the financial advisor, they will need to confirm in writing to the panel that they have reviewed all of the documentation and they are satisfied that it conforms to the regulation, failing which, or if the lenders do not fund, the financial advisor is itself liable to fund itself. So it's a very high threshold that you can imagine an independent financial advisor to take on that risk will engage its own counsel. So now you have another set of counsel which is involved and will scrutinize the entirety of the transaction. And in a setting where your pre-announcement, so the disclosure has not yet been made, the target is a public company, there's a lot of eyes that are on the documentation and a lot of intervenants which need to be satisfied that you've satisfied the conditions. And maybe one of the interesting things that we saw in our dealings through that is, while we are accustomed here to dealing with a commitment letter, so a bank that says, I will commit to fund this acquisition, and short form, holds on 10, 12 pages, terms and conditions, a term sheet of a few pages. The custom that has developed in the UK is to have what they call an interim facilities agreement. And an interim facilities agreement will be a fully baked credit agreement that is signed, containing all of the conditions and the security by the bidder, which, and by all accounts, by UK counsel that we've spoken to, will never actually be drawn on. So it's a fake credit agreement that they develop, which is there for cash confirmation purposes. Post-announcement, the negotiation with the syndicate of lenders occurs to replace that agreement. But in the meantime, they use that as the placeholder so that if things were to go sideways and the single lender had to fund the acquisition, they would be committed to fund on the basis of that agreement.
And that agreement would typically have a very short maturity date, 60 days or 90 days after closing. So a borrower has a great incentive to make sure that after announcement, they're able to negotiate a credit agreement that's going to replace this interim credit agreement.
So we see a notion such as certain funds periods or agreed certain funds period, which is the period of time for which the lender is committed to fund. It obviously needs to be a sufficient amount of time for the transaction to proceed. So you announce the transaction and then you have to go through the regulatory approvals, consents, and otherwise. Typically that'll last between 2 and 3 weeks, 14 to 21 days after the approvals have been obtained. So that's the length of time that we look at. During that period, the lenders are obligated and are not entitled to any prepayments of funding. They cannot refuse to participate. They cannot terminate their commitments. They cannot accelerate any loans related to that funding. So if there's other loans that are in the credit agreement, the particular loan for the acquisition cannot be accelerated or enforced. And unless what is described as a certain funds change of control, which is a very limited change of control trigger, illegality, so the lender it would be illegal for the lender to actually fund under its statutes, or what we describe as a major event of default, which we'll get to, the transaction holds, and the lender cannot walk away during that interim period. So what was interesting also to us in participating in these transactions is there are 3 triggers for conditionality here. There's conditions precedent to the certain funds period, there's conditions precedent to funding, and there's conditions subsequent to funding. The conditions precedent to the certain funds period are all the conditions that need to be met before the interim facilities agreement or the announcement is made. And as we mentioned, that is effectively the gamut of what we would expect. So delivery of organizational documents, all the credit documentation, fee letters, intercreditor agreement, the announcement in accordance with a regulation that needs to be published, legal opinions, due diligence report, tax structure, all equity contribution commitments, KYC or know your client documentation, and a full suite of reps and warranties. Those are given on day 1. Before you announce, all of those things need to be accomplished. Then the announcement is made and the certain funds period starts. The conditions precedent to funding after that is extremely limited. Effectively, it's the delivery of the acquisition agreement, of which the lenders do not have approval rights. It's the funding of the equity, on which you have already commitment letters with no outs, the payment of the fees, which are secured from the fund's certain financing, and the absence of illegality or a major event of default. Those are really the triggers that exist which can block a transaction. And what we saw also is other customary transaction documents that we would see in Canadian or US transactions at the time of closing. So for example, bring down of officer certificates, legal opinions, additional comfort that lenders will seek. Those will be conditions subsequent to funding, meaning that the lenders are obligated to fund, and while they can request these things, they can only request them after closing. Again, they fund, then they request certain things. So if they're not delivered, the company may be in default, but the lenders have already advanced the funds. If we look at perhaps what some of these major representations are, very limited, and we're talking about really the BidCo, so usually the acquisition vehicle.
Which in many instances is a newly formed entity, so it's a pretty easy set of reps to provide.
Exactly. So that it exists, that it has the power and authority to own its property and carry on its business, that there's no conflict with laws or constitutional documents, that its obligations under the interim facilities agreement are binding, that it's an acquisition vehicle with no liabilities or other commitments, and anti-money laundering and sanctions. That's the list. So it's very, very short. And this, as you recall, could be 3 months, 6 months after the certain funds period has commenced. In terms of major events of default or major undertakings that it cannot breach, it cannot incur debt outside of the acquisition debt that it's incurring. It cannot dispose of assets, i.e. the purchase agreement. It cannot grant security to others. It cannot issue dividends. So it's really treated as almost an SPV, shielded from all of those things. And in terms of major events of default, they are effectively a payment default, so the company doesn't pay, which shouldn't have any payment obligations at that point because the funds wouldn't have been advanced. A breach of one of the major representations we talked about, or insolvency. That is the short list. Now, there may be some adjustments depending on the transactions, but the list is extremely, extremely short, which again forces the certainty of funds for the transaction.
Now, when we're looking at whether it's SunGard or fund certain transactions, we can't lose sight of something very important. We've been talking a lot about what are the conditions to funding. Well, your obligations, your covenants, your representations and warranties, generally speaking in your credit agreement, they continue to exist after your acquisition occurs. So we've talked about limiting, for instance, representations and warranties or certain covenants. That's easy. But if you aren't focused on everything else and the implication of those covenants on the new consolidated group, well, you may well have consummated your acquisition, but the next day you could be in default with your lenders. And that's not a position you want to be in. So depending on the structure of your credit agreement, you could have what's called the day 2 default. So the day after you've closed your acquisition, you're in default. You have to go negotiate with your lenders. Can't just ignore them. A lot of these transactions are secured. Even if the target hasn't granted security, the purchaser has pledged the shares in the target. If it's not a day 2 type of situation, it may well be on the next drawdown under the revolving facility or a continuation or rollover of a LIBOR loan or a banker's acceptance. What we've seen a little bit in the market, I think it's more in the US, is that they sometimes provide what's called a cleanup period. So it's almost a grace period to fix these problems which exist. But sometimes we've seen borrowers that are so focused on making sure they can be in a position to close that they haven't spent enough time on modeling out and taking into account, well, what's this going to look like? And even things happen between signing and closing. They have to be prepared to deal with those because the lenders aren't just going to say, well, now that you've closed, we're okay, we're going to forego this. Lenders are going to enforce their rights, and it may not be an acceleration or termination of the credit facilities, but may be a difficult negotiation where they want certain additional restrictions. As they would require a waiver and amendment, could change the pricing and other provisions which can impact the way a company can operate. Similarly, in particular, in syndicated deals, or where the intention of the lead banks or lead arrangers is to go bring on additional lenders. So you have your commitment where the two lenders say, well, we will lend $50 million, but our intention is to go syndicate this loan. And we want to bring in more, and we consider a successful syndication when each of us are left with $10 million. So there's $30 million of commitments that they're going to go out to the loan market for. There's something called market flex. And what's market flex? Market flex effectively gives the lenders, or the committed lenders, the ability, without the consent of the borrower, to amend the pricing, terms, or structure of your credit facilities. So again, nothing that's going to impede your closing of your acquisition, but if they can't successfully syndicate, you may end up with a much more expensive financing that you had anticipated. Now, even though I say pricing, terms, and structure, generally speaking, these, or the scope of which items can change and how much they can change is subject to extensive negotiations. So the applicable margins for the loans, how much can they be increased? Negative covenant baskets, perhaps they have the ability to change certain baskets. Financial covenant ratios, some adjustment to those, and increases in the fees, the upfront or commitment fees that get paid to lenders. So very important to focus on this aspect of your financing. This is not something that's typically covered in the commitment letter. It's either in a fee letter, or quite frankly, sometimes it's just a standalone market flex letter. And as part of that, what's also significant, or you want to know at some point, that you have finality on your financing and your terms, your pricing and structure. There's a period during which they have the opportunity to do this. And the whole idea behind it is they have to establish that, well, if we adjust these terms, we're going to be able to bring in lenders so as to create a successful syndication. So certainly not to be forgotten, and is part of any financing that involves fund certainty, although especially with the large private equity sponsors, we're seeing the ability of the lenders to make changes is becoming more and more limited. As I said at the outset, this is a seller's market, and sellers are really going to take a look at how is the borrower going to be, or the purchaser going to be able to finance this acquisition. So there's equity coming in, and there's debt. And in many transactions, we're now seeing, not only do they want to know, well, not only is there no financing out, but on top of that, they want to see the commitment letters that you've signed up, because they want their counsel to look through it and make sure that the SunGuard provisions, or the fund certain, well, in the UK it's different, but certainly the limitation, the conditionality, because what we didn't talk about is in the UK, they have their conditionality on non-public transactions is quite limited as well, more out of the norms and customs out there than anything else. With that in mind, they want to see the commitment letters. They sometimes want detailed representations and covenants in the purchase agreement, where the purchaser is making statements about its financing, saying that it's going to take all efforts or use all efforts to ensure that they're in a position to close the financing. When I first saw it, to me it was contrary to the notion, you don't have a financing out, why do you have to be so fixated on these things? But in particular, when you have a private equity buyer, They will go through your commitment letters and make comments. They even want to see your fee letters, although it's permitted to redact so that they don't know the commercial terms, because at the end of the day, they're not concerned about how much your financing is costing, but rather want to ensure that it happens. There tend to be requirements for the purchaser to advise the sellers of any material developments relating to the financing that could impact the availability at closing. On the flip side of that, we have a seller's cooperation covenant in many instances. As I just talked about, a lot of times there's going to be a syndication process that takes place after the signing. Well, especially if the target is going to dramatically change the consolidated group after closing, in going out and trying to syndicate the credit facilities, it's going to be important for the lead arrangers to be able to have the information and present information about the consolidated group, including the target. So you tend to see such things as sellers agreeing to participate in lender meetings, assist with the preparation of syndication materials, execute certain definitive documents, and we see in particular security agreements, allow for due diligence by new lenders. And again, this does not take away from the fact that the purchaser can't do any more due diligence, but allows due diligence for the purposes of the syndication process. And as we've now mentioned a couple times, know your client types of information that is part of the requirements, which are becoming more and more onerous from each of the financial institutions. This covenant is limited by there being no requirement for them to do anything which would cause any of the sellers or their management team to incur personal liability. It would not cause any or create any risk that the conditions precedent to closing of the SBA would not be received or would not be met. I think the last thing, which is, I know this will surprise you, has emanated more from down south where litigation tends to be a little bit more common. There's something called Xerox provisions. And what are Xerox provisions? Well, there was a 2009 financing that involved Xerox where these first came into play. And effectively, even though the lenders are not party to the share purchase agreement, they want the sellers to recognize very clearly that if things go sideways and the acquisition does not close for whatever reason, they have no ability, the sellers, to try to pursue in the courts the lenders, whether for tortious interference or some other novel claim that our very creative litigation friends can come up with. So this, we don't see it as much in Canada, which I think is a function of being a little less litigious, but something that U.S. lenders are very focused on. And as part of that, they want to see what they'll call a friendly governing law clause for the purchase agreement, i.e. a jurisdiction that is not plaintiff friendly. A significant majority of U.S. deals we see governed by New York or Delaware law, so these are friendly from a lender perspective. Waiver of jury trial. I'm sure you've all read plenty of articles where there's outrageous jury awards, so no one wants to see that. And the lenders insist that there be a clause inserted which makes it clear that even though they are not a party to the purchase agreement, that they cannot that they can benefit from these provisions. So I'm not sure we're going to see Xerox provisions come to Canada in the near future. But
we're seeing some of them. I mean, they're not common, and some of these provisions that you mentioned, for example, waiver of jury trial or selecting New York law would be completely foreign and unnecessary in a Canadian transaction. But we deal sometimes with U.S. firms that insist on having these types of things, and you'll have. I recall some discussions with lenders, and they're like, well, we have no privity of contract. We're not party to this contract. How could you even be sued? And in the Canadian marketplace, it's not something that we would see. We see them trickle in. It's rare. I agree, but these things evolve over time, and we're starting to see them.
Right, and don't forget, even if at the end of the day, there's no award that may be can result from it against lenders if they're dragged into litigation because the acquisition that never got consummated, and the sellers feel that they've suffered significant damages as a result. They're certainly going to sue everyone and then just see how it plays out. And so I think that is why it's very much a focal point in the U.S. And we may see it here, but I think our courts are approach things a little bit differently. I guess one last piece when we're talking about the purchase agreement is that even in SunGard situations, there is typically a restriction on the ability of the purchaser to amend the share purchase agreement or the acquisition agreement in a manner which could be adverse to the interests of the lenders without their consent. Because remember, the lenders are signing up and saying, this is our purchase agreement. We're going to fund based on what the bargain of the parties is as set out in this agreement. If, for instance, just because for their stock price or otherwise, the purchaser decided, I'm willing to forego certain things and waive certain conditions precedent, well, that may well change how the lenders view the transaction. So in those instances, they'll have to go back and get consent.
So what we saw today, try to bring this together. If you're a company that has strategies of acquisitions in the future, important to focus on that up front and negotiate with your lenders to make sure that you're permitted to perform those acquisitions. So you need permitted acquisition concepts within your credit agreement. You need to be able to use the proceeds of the loan for that purpose. If commitments are obtained from lenders to fund an acquisition, the seller will certainly be interested in ensuring that funds will be certain at the time of the acquisition and that the obligations can be met between the signing of the purchase agreement and the closing itself. And to tie that together, the purchase agreement itself that's negotiated with the seller needs to account for these subtleties in what's permitted, what are the conditions that need to be met so that they're lined up, and you avoid litigation risk if the transaction for one reason or another fails. And what we now see also in transaction agreements is what we call a reverse break fee, which is if there's a financing failure, so if the conditions for whatever reason, those limited conditions aren't met, the only recourse that the seller has is for a break fee and move on. So we eliminate specific performance, you eliminate litigation risk. And those are all things that need to be contextualized and form part of the decision. So key takeaways that we wanted to share with you. As we said, any borrower that plans on being acquisitive should make sure that its credit agreement doesn't unduly limit it and that it's able to pursue its acquisition strategy. Financing out provisions, as Howard mentioned a few times, very rare and far between in transactions these days. There's multiple bidders. It's a very competitive market. And so the certainty of funds becomes almost a given that the sellers will insist on seeing. And very important, as Howard mentioned as well before, you can't ignore the fact that even if you're able to satisfy the conditions to fund the acquisition, there's tomorrow after the acquisition, and you don't want to be in a default situation right after that. So you need to be careful to always manage those things in the context of the transaction. So if there's questions, comments, we're happy to take them.
Comments? I thought only questions.
So Howard and I actually last year we were involved in a significant transaction in the UK, acquisition of a public company, and it was we had been involved in others before, but this one we were really leading the transaction because it was a Canadian client that was doing a large acquisition, transformative. It was doubling in size, and it was a very interesting segment. So
yeah, and just to be clear, it was, or give a little bit more context, it was a Canadian-based company with significant operations in the United States, but no presence outside of North America. and this transaction was going to more than double its size.
Yeah. And so the company already had a credit agreement negotiated with a bank and a very large syndicate, which had within it the limited conditionality concept and incremental loans or accordions. But the limited conditionality context was US styled. So it wasn't adapted for the UK market. And so what we did there is we negotiated pre-announcement with the lead agent only, an underwriting commitment where they said, we will fund the acquisition, we will commit to fund the acquisition, and because we need to make certain adjustments to the credit agreement, we will backstop that in case when we go to the lenders, they refuse to participate. So plan A, we'll go to the market, we'll ask for everybody to participate. Plan B, we will backstop, we will refinance your entire transaction. And that because we already had that construct, we were able to negotiate that with the lender in a way that would allow us to simply amend and continue on.
Yeah, and just to add to the particular circumstances, they really had two, call it backstop commitments. They had a first commitment, which was, again, say it was a $50 million, the $50 million which was required. If lenders only came in for $30 million, they were going to put in the extra 20. But by the same token, what needed to be done in connection with the acquisition were a host of amendments to the existing credit agreement, some of which required, I believe it was unanimous consent.
Yep.
So not only did the lead bank say, we will make up a gap, but the lead bank also said, if you cannot get the consents you need from the existing lenders, we will take out the existing debt and fund all of the new debt. So there were a couple different scenarios which could occur, and
it was layered, right? So because in credit agreements, oftentimes you'll see provisions that say if you get a majority but not unanimous, then you can yank out the lenders which don't want to participate. So every permutation was accounted for, depending on what the optimal strategy, with the ultimate plan B being we'll just redo the entire thing. So it was staggered. The first pre-announcement we negotiated with the lead agent, full commitment papers, full interim facilities agreement, all of the due diligence, everything. That was on day one. The announcement was made. It was a public offering that was made. Step two was in the 60 to 90-day period after that. The agent, who has now a large commitment, doesn't want to hold it, went out to the lenders to syndicate all of that. So we negotiated two amendments, one to implement the permissions we were looking for, and one to implement the certain funds bucket only. So the credit agreement would survive on its own, but then you would have a separate tranche, which was certain funds for the UK acquisition that was done.
Yeah, and just to be clear, and something I failed to talk about a little bit earlier, the types of commitment letters that are in place for SunGard transactions generally, and certainly the one that we were dealing with here, are very lengthy commitment letters. They could be 50, 60 pages with the entire financial covenant definition section effectively replicated in the commitment letters. So the notion of a commitment letter where, say, customary representations and warranties or customary covenants and events of default, that's not the type of commitment letters we're talking about. In some private equity deals, they do simplify it a little bit, especially with respect to covenants, representations and warranties and events of default, because they've done other transactions with the lead arrangers and say, we agree that this transaction that we've already done, that will be the documentation, the starting point for the documentation that we will use, and it will all have to be consistent with that documentation for the other financing, which is unrelated other than it's another portfolio company of the same private equity sponsor.
So through the steps, announcement, post-announcement, we renegotiated with the existing lenders.
Well, we got consent first.
Consent first. After that, the company went into what they call in the UK a scheme, which is a consensual transaction, but needs to be almost like a plan of arrangement. So it goes through a court process to get approval of 100% of the shareholders, or squeeze out if there's less than that. Then you've got your disbursements, which is based on the fund's certain protocol that's been established. And then post-acquisition, you have the conditions subsequent that need to be met.
Yeah, and I think the other piece, and neither Serge nor I are securities experts, but layered on top of that was the commitment letters and the credit agreements had to be structured both if the scheme went forward or there had to be a squeeze out, and even if it was below a squeeze out level, what would happen. So there were different permutations and combinations. And again, going back to Fund CERN, the investment bank, which provided the cash confirmation, had to make sure that in the worst case of all the scenarios, not only would our client have all the funds necessary, both on the equity side and the debt side, but the commitments would actually also be still in place for a long enough period. Because the other thing that happens in commitment letters is, and because it impacts financial institutions based on, the regulatory requirements, is once they've committed capital, there's a cost of doing so effectively. So they want to have a drop dead date, and it's important that the cash confirmer be comfortable with that drop dead date is such that everything that could be envisioned will have been achieved at that point, because even for some straggling shareholders, it's unacceptable that there isn't a commitment, even though at that point the amount in question is quite frankly insignificant.
Thank you.
Thank you.
Thanks very much.